Hi guys, today we're going to talk about the difference between concessional and non-concessional contributions into superannuation. So obviously this is based off the 2017-2018 financial year. Each year, there's sometimes some changes to superannuation. A lot of them remain the same, but you should always double check if you're working on a different financial year than this one. So for the purpose of this, we're going to assume that you've already got a superannuation account with some money in it. And we'll start off with concessional contributions. So concessional contributions are contributions made to superannuation where a tax deduction has been claimed. For example, it might be employer contributions. So your employer pays SG contributions at the current rate of 9.5%. That's a concessional contribution because your employer is claiming a tax deduction for it. So if you earn, say, $50,000 a year, you would get employer contributions of $4,750 a year. Then there's salary sacrificing, which is also a concessional contribution. This is where you forfeit part of your salary in exchange for increased superannuation contributions. So again, it's concessional because your employer claims a tax deduction for, instead of paying you that amount, they transfer it into superannuation on your behalf. And therefore your taxable income is reduced because less is assessed at your marginal tax rate. So you might say contribute $10,000 a year salary sacrifice as an example. If you're self-employed, you might make personal deductible contributions, which are also concessional contributions. And this is, paid from your business bank account, for example, or from your personal bank account, and then you claim a tax deduction for it. The annual cap over a financial year is $25,000 for all concessional contributions. So employer, salary sacrifice, personal deductible, whatever it is, all of them add up and need to be below that $25,000 per annum cap. So you can see in the example here, we're contributing a total of $14,750, which is below the $25,000 cap. All concessional contributions incur contributions tax of 15%. So the contribution is made, the gross amount, $4,750 in this case by the employer. 15% comes off that as it enters your superannuation account, and the net amount gets allocated to your member balance. So if you're going to be salary sacrificing, you want to make sure that your personal marginal tax rate is above 15% in order for it to be beneficial to salary sacrifice. Moving on to a non-concessional contribution, this is a contribution where a tax deduction is not claimed for the contribution, and so what happens is you get paid your wage or salary into your bank account, tax gets deducted from it, PAYG tax, and then after it's gone into your bank account, you decide, okay, I'm going to contribute part of that into superannuation. The maximum non-concessional contribution cap each year is $100,000. That's the most you can do, anyone of any age, into superannuation. However, using the bring forward rule, you are allowed to bring forward up to 2 years worth of the cap, so 2 additional years, and contribute up to $300,000 over 3 financial years with no regard to the $100,000 cap, provided you stay under the $300,000 cap over a 3 financial year period. The bring forward rule is only triggered in the financial year where you exceed $100,000. And the bring forward rule can only be used by people under the age of 65. Over age 65, any contributions you need to satisfy a work test, which means you need to work at least 40 hours over a 30 consecutive day period in order to make any contributions to superannuation. And that work test must be satisfied prior to any contributions being made and in the financial year that the contributions are being made. The benefit of contributing to superannuation, making concessional or non-concessional contributions, is obviously saving up for retirement in a tax-effective manner where your superannuation balance is invested and there's a maximum tax of 15% on all of the earnings within super. So that's the reason why we contribute to super, as opposed to investing in your personal name where earnings are taxed at your marginal tax rate. So earnings, I mean income, interest, capital gains, all of that. One other thing I forgot to mention was that with the 15% contributions tax for concessional contributions, this can be rebated for low income earners and does incur a surcharge of 15% for higher income owners earning over $250,000 per year. And that's it. So make sure you subscribe to this YouTube channel for more superannuation information and strategies in order to maximize your superannuation savings. Thanks.